I'm Charlotte McLeod with the Investing News Network, and here today with me is Brian Leni, founder of Junior Stock Review. Thank you so much for being here. Great to see you.
Thank you for having me.
Amazing. And so today we are meeting at PDAC. It is the second day. I want to start by taking your temperature on sentiment at the event.
I thought it was really good, actually.
Yeah.
I presented the Metals Investors Forum the 2 days prior, and it was pretty good, but I would say it was a little bit down from the Vancouver event last month. But the Sunday at PDAC is as good as I've seen it, I think, in the last couple of years. So I was very happy to see it.
Very good. And so maybe a fun question as well to begin. What's the most interesting piece of information you've heard here so far?
Well, that I probably can't talk about yet.
Can't divulge that.
Yeah. But no, there were some interesting companies that I came across. And we were talking just before this interview about critical metals and minerals and how that has really kind of captured the audience. And I think there's so much attention, especially from the political realm, that are at this conference. You know, there is, you see the amount of police and stuff. You can see there's a lot of politicians bopping around. And because of that, it's really propelled critical metals, I think, to the forefront. And that's why everybody's talking about it.
Yeah, definitely that does seem to be a theme here. And when we met in VRC just a month ago, we talked about a bunch of different metals. That was really great. Today I want to take a different approach and talk about how you approach investing, essentially. So you told us many times that you are looking for companies with assets that will perform well despite whatever the metal price is doing, right? So that allows you to be sector agnostic. But I would imagine that also opens your horizons up so much more broadly in terms of where you're looking. So how do you start then from narrowing it down?
For me, and I think it should start with every investor, is kind of understanding what they're looking for in the sector and from themselves. You know, we each have different strengths, technical ability, risk tolerance, and all these things sort of apply into how you're going to approach the sector. And I think, for me, I've got a good background technically, and I've been an investor for quite a long time. So I can leave it quite broad and kind of look at all the different opportunities. But I think for probably the average retail investor out there, you have to be much more concentrated in what you're looking for, I think. And especially when it comes to risk, because there's a broad spectrum of risk in this sector. And exploration being at one end and the production and royalty companies being at the other. And you need to find where you are on that spectrum of risk. And then that kind of funnels you into the companies you should be looking at and fit your investment profile as an investor. And I would highly suggest that's where people start.
So there's tons of information out there really on when to buy, right? We've talked about this before, how you approach that. I want to look at when to sell, because this is a topic that you covered in your Metals Investor Forum presentation, which you were nice enough to send it over to me. You actually included a formula that people can use to calculate their sell price in there. So that's very interesting to me. I wondered if you could go over that. Yeah,
sell price, this is, I think, most often investors are obsessed with the buy price, and that's good. Especially if they're buying something that's worth or selling for less than it's worth. On the other side of that is the unfortunate part about this sector and maybe investing in general is investors will ride that share price up and ride it all the way back down, and this is a big problem. And one of the biggest things, I've had a couple of amazing mentors in the sector and as an investor, and learning how to sell was a big part of kind of bringing everything together for me. And so when I look at a company, I come up with a valuation. And so, the value, there's the price to value ratio. The price is what the market says the company's worth, and the value is what you as the investor say it's worth. And so that value proposition is the sum of the discounted cash flows over a period of time. Once you have that valuation, depending on your technical ability, how much confidence you have in the resource and where the company is, then you can come up with a discount factor on whatever that value is. And that, once you have that value, that becomes your sell price. And after the company has completed X amount of catalysts, they lead up to hopefully having market recognition, and they reach that sell price. And at that point, you need to sell, or at least begin selling. And what that does is reduce your downside risk and completes that investment thesis that you had prior to getting into the company.
Can you use that same formula or similar to calculate the company's current valuation? Is it overvalued, undervalued, fairly valued?
Oh, 100%. And that's indeed what you should be doing. And of course, staying on that undervalued side of things rather than buying something that's fair value or overvalued, which you definitely have a lot more risk in. And it's all, to me, and again, my mentors that have been in multiple decades in the sector, you have to protect your downside risk. It's basically impossible to say where the metal price is headed at any given moment, and that share price can fluctuate with it. And so when there's profit there, you need to take it.
Okay, so this involves using numbers, looking at data. I think that some people might feel a little bit intimidated to do that. I know I certainly am. So do you have any advice for investors when it comes to validating what they're looking at? If they do their calculation, how can they feel confident?
Well, one thing I would say, if that's where you are and you can recognize that, you're ahead of the market there. What I would say is you're probably going to look at companies that either have a technical study already completed, so they have a PEA, a PFS, or a feasibility study, and then you yourself, all you have to do is be able to read. You just go through, you go back to those sensitivity tables, you find what the after-tax NPV is, and that, the other kind of interesting point these days is look for a discount rate around 10% or higher, because the cost of capital is that much higher. So you have to be adding a further discount. Most companies are going to use a 5% discount, and that's what they're going to use for their marketing because it looks the best. But really, in this kind of setting that we're in, a 10% discount rate is probably the minimum that you need to be looking at. From there, you also, if you can't calculate those sum of discounted cash flows, you're probably better off looking at the production companies, the royalty companies, where it's much, much easier, I think, to look at the balance sheet, look at the profit and loss statement, and say, oh, is this company on solid ground? And again, you're just analyzing, columns that have already been calculated for you, and you can get an idea. So again, if you know yourself and your strengths, that'll direct you where to go.
Yeah, okay. I like that we're starting a base from, can you read? So hopefully most people can do that. So this is really helpful, I think. Can you share any other tips for investors when it comes to interpreting press releases, drill results? How did you begin looking at that?
Well, again, this goes back to what you know in the sector. If you don't understand drill results, you probably shouldn't be in anything that has a huge component of it relying on you being able to understand, probably ahead of the market, right? But I think a lot of investors try to do that. The exploration is very sexy. The CEO gets up, does a 10-minute presentation, and you want to invest. You see the potential. You know that these things can go from 10 times what you invested. But the problem is usually what people are going to do is see how the market reacts to something and then decide what they're going to do. And if that's the way you're going to do it, sometimes you might get lucky. But often that knowledge discrepancy or that being behind the market is going to hurt you. And over the long run, I would say you need to put your time into grab a geology book. There's some great ones. Robert Stevens has a great one on going through the different deposit types, the kind of drill results you're looking for, the grades of economic deposits, and kind of going from there. But otherwise, if you have no base, you need to create that base before you go forward with it.
Exactly. And I think one theme that I'm really picking up on here at this conference is that you don't have to necessarily go into exploration, those risky plays, in order to make money or find good value here, because the larger companies right now are at such lower valuations. So is that something that you find?
100%. That's again, people get obsessed with the 10 to 1, and it kind of clouds their judgment when you can buy some excellent companies that, in terms of risk, are definitely on the other end. And you can sleep at night knowing that these guys are producing, they've got exposure to the metal price, but really, these are senior mining companies, well diversified, especially on the base metal side. Companies like BHP, Rio Tinto, you're getting a wide variety of exposure to metals. And again, it may not be that 10 to 1 potential, but if you could double your money on the next sentiment wave in this sector, I think you're well ahead of the market, and you're well ahead of knowing where you stand in that market and what's going to benefit you the most.
Okay, I think that makes total sense. And going back to selling, how do you combat that fear of missing out, FOMO? We hear about buying in tranches, right? Can you also sell in different steps?
Absolutely. And this is something that I think you definitely need to come up with as a plan. So, you said that you find a valuation, you find your buy price, you buy, but you should also plan out how you're going to sell. Maybe you don't need to sell at all at that sell price. In fact, depending on how the market is going, like if it's volatile like it is now, maybe you want to set a 20 or 30% profit for your first tranche of selling. And then what we've seen is, this last bump we've had, the market moved up 20, 30% on most of the good juniors. You could have sold, it's come back and you can buy right back again. Nothing has really changed with the companies, but you've made an extra 30%. You put that money back in and you've kept some profit for yourself. So planning out your profit schedule according to whatever you see in the market, I think is an excellent way to do it. And that's something I do.
Right, and do you think you could share an example of a time when maybe you felt like you really wanted to hold on to this stock, but logically you knew it was time to sell and that worked out for you?
Oh, absolutely. Well, continually it's a fight. Like, you brought up FOMO, and you can get caught up in the momentum of stuff. And, especially when it's almost a self-fulfilling prophecy. The herd is getting into a company, the share price is going up, it's eclipsed your sell price, but you feel that momentum. And honestly, I'm not really sure. It's probably going to be different for everybody. For me, I go back to my experience and I can actually hear my mentors in my head saying, sell. And it's really helped me, realize, because I've lost money in the past. And I have to listen to that voice of reason and follow that step. Actually, the other side to it is I have rules to invest by, which is basically a framework for my decision making. And that sits right next to my desk on my right side. And I refer to that quite often when I need to be reminded or I find myself in an emotional state. I need to look at that, remember what's got me to where I am. And I highly suggest everybody else do that too, make it a part of their process to look at that framework for decision making that's rooted in themselves and can contain the emotion, because it's super hard to do. And I still make emotional mistakes. So I don't know if I have a definitive answer of how to do it.
Okay. No, that was very helpful, I think, though. And so in your presentation at the Metals Investor Forum, you also touched on different types of bias, including misweighing bias. I found that pretty interesting. So I wondered if you could explain it in the context of the resource sector.
Sure. Again, and I flow it back to kind of what our whole conversation is about. You have to do certain things in certain steps to make sure that you get the maximum impacts from them. And the misweighing bias is doing the right things but in the wrong order. And it's kind of an interesting concept, and I kind of conveyed it to like living a healthier life. It's, people will go to the gym, they'll buy a gym membership, or they'll take vitamins, but if they don't change what they're eating and drinking or smoking or all these other things, you can't live a healthier life. So in the investing sector, it's the same thing. To me, it starts with self-awareness. You can't know what to buy until you know what you want and what you're best suited to be in. Second, price to value ratio. You need to be able to, once you know what you want to buy, you have to find something that's selling for less than it's worth, and all that other criteria that goes with it. So you have to do all these things in an order to make sure you get the maximum impact or the maximum profit as possible. Whereas people might want to jump and buy a quality company that's selling at a fine or a fair price, you might say, or overvalued in the bad case, and don't have that downside risk. So you need to start at the top and do those right things in order if you want to get maximum downside protection and maximum profitability in this sector, in my view.
So I think clearly you have the psychology of investing on your mind a lot of the time, which is really interesting. It feels like investors almost have to do battle with themselves on a daily basis just to get out of there on top. So are there any other tips that you would share on that note?
Yeah, well, it's, and it's guys like Rick Rule, he says your greatest enemy is to the left of your right ear and to the right of your left ear. And he's absolutely right. Like, when I first heard that statement, I understood what he said, he was meaning, but until you unfortunately experience it, you can't maybe necessarily relate. And maybe that's what has to happen with everybody. But all my mistakes, especially my biggest ones, have all been my own fault. And I think if you realize that, then if you start with yourself first, you're again way ahead of the crowd, and you're on your way to probably success in investing.
So in this current environment that we're in right now, what do you think is the risk that investors are maybe most going to make if they're going to make a mistake?
I think being too susceptible to the fear that's out there. There's a lot of the media wants, and it may be rightfully so to a certain extent. You have war in Europe. You've got an inflated economy. You have all these other social issues across the world, and I think people get wrapped up in that. And they're expecting a crash, or they're expecting this or that, and it prevents them from deploying money into the market. There's a number of people, again, mentors, that have told me, you can't predict the future, and you can't let it prevent you from taking the steps to make money, especially in a sector like this. That's, really the unfortunate side is that, war will probably make metal prices go up. it'll make a lot of prices in our world go up, and there might be a momentary down, but you can't pick that bottom. The point is, you want to go out there, find good companies, start deploying money. You don't have to put it all in. You can do a tranche style, but you can't let the fear overtake how you want to participate in the sector, because there's going to be money made in the meantime.
Somebody's going to make
That's
that
right.
money. Hopefully it's going to be you. So any other thoughts that you have on your mind right now, things you would want to wrap up and leave investors with at this moment?
I just think that there's some great opportunities out there right now, and for the investor, again, that isn't fearful, knows what the risks are, but isn't fearful, it is going out there looking for good companies. There is a ton of good stuff on sale right now, and I think this next run, which I think is going to start this year, I think is going to be a big one. So there's money to be made.
Okay, well, thank you so much. This is a pretty deep conversation on how people can be investing for an early Monday morning. Really nice to have you here.
Oh, thank you for having me, Charlotte.
Amazing. And once again, I'm Charlotte McLeod with the Investing News Network, and this is Brian Leni with Junior Stock Review.